Couple things we're going to talk about. So there's a lot of economic uncertainty right now, and people have been talking about real estate specifically. So we'll go over a couple things to look at, and it's things that are a little bit different than what we've looked at in the past. A lot of times we've been playing offense in the past couple of years, looking at kind of the returns we can get. But I think now with a potential recession coming, we really got to start playing defensive. Like, how do we focus on capital preservation and cash flow? And those are really the two things that we're looking at right now. Kind of, it's always difficult with two monitors. I always think it's a good idea. Okay. Okay. So Peter, tell me a little bit about kind of what you've been hearing. You always have your ear on the ground of kind of where we're heading, what the kind of prevailing thought is in terms of kind of just the economy for the next like 6 to 12 months.
Yeah, I don't think it's any surprise that everyone thinks that we're either in a recession, we're headed for a worse recession or a heavy recession over the next, I'd say, before the end of the year. If we're not there right now, we're going to hit at least some point in the next 3 to 6 months. I think most people, if again, I'm talking to different experts in the area, but of course, everyone's just predicting as best as they can. And there's probably some truth in some of these predictions, but most people are they're predicting some tough times for the next 6 to 18 months. And I think that's a unique, it's a unique time right now. And I don't know if people have seen the chart that we often show with a lot of these webinars or things we do, where there's like the market cycles that we talk about. Again, every market throughout time, this is not something that hasn't happened before. It's happened before and it'll happen again. There are cycles. And so I think it's really important for people to understand, where are we in the cycle of how these things work? And then ultimately, how can we take advantage of the time where we're at this point in the cycle? Because I'm a true believer that at every point in the cycle, there are opportunities. However, the opportunities might be a little different. What you look for, the criteria, what questions you ask, that can be different, but there are opportunities. So really understanding where you are in the cycle, being realistic about it, right? And not being like overly optimistic or overly fearful in times, like just knowing exactly where you are in the cycle and understanding the different things to look for is where people, that's where people can really, really prosper and do well. And I think that, where we are in the cycle right now, people, I don't know if you're feeling it, there's probably a lot of fear out there right now and anxiety. And that's normal. I mean, again, that's part of the whole cycle that of real estate markets, of the economy. However, they've shown again and again that people who can be resilient during this type of time, people who can be, they keep their eyes out for opportunities. This is when the greatest transfer of wealth happens. This is when the true opportunities reveal themselves. I got to turn that. Let me turn off that Slack notification. This is when the true opportunities present themselves, and this is where you can absolutely set yourself up to take advantage of this market upswing. As we know, there are only a couple of these that usually happen in your prime, in your lifetime. Pranay, how many have you seen? Probably one.
Too many. Too many.
No. You've probably seen one prime in your prime, right?
Oh, in my prime. Yeah.
Advantage of it. This was like the longest, right?
Yeah.
Bull market that you've seen, especially in real estate.
Yes.
And I don't think you were there at the very beginning of this to take advantage of this. But this next one, you will be there at the beginning. And I think all of us will be there as a community. So as long as we can kind of stick together, we can help each other make great decisions during this time, we'll all be poised to really, really set ourselves up, I'd say, for the next decades by what we do in the next 2 to 3 years.
Yeah, I mean, who do we know that is the most successful in real estate right now? It's the people that bought stuff in 2008, pennies on the dollar, right? And the properties are killing it right now. So even in early 2000s with the pandemic, everyone was so scared, while there were others that were able to take advantage of that, and they killed it by now. So it's during the time in the recession, it's everyone's going to be scared, everyone's running away, but the people that think about what's happening, realize where we are in the cycle, and are able to take advantage of it, they really reap the rewards. And most of wealth is actually created on the downturn.
I will tell people, when you're looking at opportunities right now, when you're looking at deals, again, they're less deals, I'd say now that I'm seeing anyways, come across my plate than before. Make sure you're asking people about the story. I think the story is really important right now. Why should I invest? And this is, I'm talking about you because this is your heart and capital. Why should I invest in this deal right now in this time, considering everything that's happening? And if you're hearing the same narrative that you heard a year ago, 2 years ago, hey, this is a good price and we're going to just get in there and we expect to, bump everything up. And it's the same narrative as before. I think you should take pause. And I think you should ask, okay, why is this going to work now? Why does it make sense right now? Why does it make sense if it continues to, there's continues to be a bottom over the next 2 years? And then also, how is it set up on the backside of this when things do start to grow and increase again? How is this poised to take advantage of that time as well, too? So those are the basic questions that we've been asking, even when we're looking at deals. And I'm an investor as well. So looking at deals myself for investments, those are the questions I've been asking. I really encourage everyone else to do the same.
Yeah, I like to look when, especially these days, I was talking about playing defense. I like to look at three things when looking at deals. Number one, like Peter mentioned, the purchase price, right? That's something that never changes. And what has been going on the last couple of years, prices have been more and more inflated, but interest rates have tripled. So you would expect there to be a change down. And that hasn't happened. So now the mortgage that you pay every month is just so much more. So I expect there to be a big discount on a property that I am buying today as opposed to last year, because interest payments are just so much more. If I want to still have a decent return, something that's risk adjusted, I need to have a purchase price that's less. So, like Peter was saying, there needs to be a story around that. I need to see a big drop, 10% plus, ideally 20%. And so someone's asking, and we'll mention this a little bit later, like why are you getting such a big discount on Encanto? There has to be a story on that. And we'll talk about that in a little bit. Number two, we're looking for is cash flow. So in the past, we've really been focusing on growing net worth, right? That's what most doctors care about. But these days, cash flow, cash is king. You've heard that. If a property is doing so well that it could cover all its expenses, has a nice big fat cash reserve, and could do 3 to 5% like our new deal does uh, per year in investors' pocket, that means it really can handle anything that the world can handle on it. And then the last thing is debt. I'd love to hear kind of how you're looking at debt and approaching properties and the type of debt that you would recommend, Peter.
The good thing is, I would say that some of the deals that people got into a year ago or 2 years ago are, even though that there was a time of a good amount of optimism and the market seemed better, those deals are more at risk than they are today, I'd say, because we're going in with eyes wide open. Like back then, I think if you asked somebody a year and a half ago where rates would be in a year, I will tell you 0 out of 100 people would have told you it would have increased by 5.25%. It's never been done in history. It's never been before. People expected rates to increase, but not by this much. I think the highest ever in a year span, if I remember, to correct me if I'm wrong, somewhere around 2%. Nobody's ever seen 5.25 added to the basis for these interest rates. And so all the underwriting, I would say for any deal back then, nobody underwrote 5% increases for that. And so deals were made under those circumstances. Deals that are happening today are completely different in terms of the debt that's being put on, the underwriting that people are looking at. I think people are going in with eyes wide open right now. This is where the loans are right now. Interest rates, could they go up a little bit? Maybe. So let's, but they're definitely not going to probably go up another 5%. But what is that debt going to look like for us to be able to last through the next 3, 4, 5 years? And so people going in a little bit more eyes wide open with that. So I think that's a nice thing. I think that's good for people that are looking to invest right now. A lot of people are looking at opportunities where the interest rates are fixed, because at the very least they know their bottom for this. And especially if you can get something fixed for 3 years is great. If you can get fixed for 5 years or even more, possibly, though, that's fantastic. People, interest rates are what it is. But if they can make the numbers work with this current interest rate, then they know that even with rent growth, if that happens, again, no one's necessarily banking on that, but if rent growth does happen, and the market does continue to shift and get better over time, it might get worse, but then eventually better on the back end, then people feel like they're going to set themselves up well for 3 to 5 years. So again, debt is the biggest kind of source of risk in any deal. And I think that understanding that downside, understanding where that's at, how the operator syndicator is handling risk, and understanding what kind of debt they're putting in place is one of the most important questions you can ask in today's age. So that's what I'm seeing. I'm seeing most people put in longer term debt right now at the current rate. If you can get something like interest only payments, even better, because that lowers the amount of obligation you have in terms of how much you have to pay. But that's what I'm seeing. Are you seeing anything different?
Yeah, same. Last couple years, people have gotten adjustable rate mortgages, and so have we. But what we bought a hedge against that called an interest rate cap, meaning that interest can't go above a certain amount. And we're very thankful. At the time, it didn't seem like the most smart thing. Why are you paying 50,000 when interest rates are 0%?
Yeah.
But we did, and we ended up doing okay. We hit the caps and our deals are doing okay. Many people may have seen the Washington Journal article about syndications, and the gentleman that had to give his properties back, he actually didn't get an interest rate cap. That means every month his interest rate gets reassessed. So he bought in at like 3%. Now it's 7%, right? The prime, which is 5.25, plus whatever spread he has. And there's no one in the world, you could have the best property in the world, it can't survive a 3 to 7% increase. And that's unfortunate for him, and he had foreclosure to a lot of units, and we really feel for those investors because they put in their hard-earned money. But that's kind of what differentiates us and him, because we have been doing this. We always partner with people who are experts, but we always really, really think about the worst case scenario. That's the doctor way, right? It's like even if there's a 1% chance of pulmonary embolism, that's on our differential. We really think about that, and we're very risk averse in that sense. And that is definitely the biggest thing to keep in mind. So our new deal, we're actually doing a 5-year fixed loan, 5 years of interest only. And because the property is so energy efficient, we actually qualify for a green loan from the government that's actually zero point 0.2 or 20 basis points lower than what anyone else would get. So it's kind of a unique opportunity to get something that low.
By the way, if anybody has any questions, we're going to start answering questions in a little bit. We have a Q&A button down there. If you guys can throw in any questions, we're happy to answer as many of these as we can in the time that we're here with you. I know that Pranay had some other things he wanted to talk about, but just wanted to make sure that people understood that that was available to you. Some people have actually, I just checked, looks like some people have asked some questions.
Mhm.
That looks great. Feel free to continue to ask questions in there in the Q&A.
Yeah, so someone asked about why we're getting a good price. And Peter was talking about a good story, but you should dig in, right? People are very good storytellers, so you want to dig in and really make sure that the story makes sense. So we're buying this from a builder. So that builder creates this brand called Cabana. They're very well known in the Phoenix submarket. They sold a property in August 2022. So not peak prices, actually when prices were on the downside. 93 million. Same property, copy paste, 286 units, 600 square feet average. They listed ours in September, so not very far, for 85 million. And they got hit with interest rates. Interest rates went up a ton between that time. And we offered 55 million. So they kicked us out of the room, but not that hard. So we whittled them down to 63 and a half, and that's what we're buying it for. So 222,000 a unit, 21-ish million discount. What is really key is our pro forma, what we plan on selling at is 307,000 per unit. But someone already paid, like I told you, in August of 326 a door. So we know the value's there, and we have 5 years to get there. And they bought it directly from the developer. So we're actually doing a lot more value add than they did. We're washer dryer, covered parking, electric car charging, and all that, a lot of outdoor space stuff. So we know there's going to be a lot of value there, and we have 5 years of getting there. And the biggest risk is taken off the table by getting fixed long-term debt. Someone, so do you think the builder goosed the occupancy a bit by offering low rents to try to get above a 90% occupancy? They could have, but we get the daily reports, so we get to see what they're doing, what type of rent, and we're actually asking them to push rents because the studios are uh, being sold out so quickly, and they're obliging. They what after you kind of get under contract, people want to show that they're good stewards of the property. And this seller, we've been trying to work with them for months, and we hope to work with them again in the future. So uh, I have seen some funny business like that in the past, but after you're on contract and you're looking every day at the reports, it's kind of hard to hide things. But we're always on the lookout. Let's see. Uh, could you describe the roles and responsibilities of the partners in this deal? So, as you know, Ascent, there's three of us. Peter is the CEO, visionary, and kind of helps us with direction and strategy and the beautiful face. And I kind of run the day to day. And then Myth is really our numbers guy, acquisitions and asset management. And Sunrise, MD and Ian. MD is operations and Ian is kind of acquisitions. I think syndication business is three separate businesses in one. Number one, acquisitions. Finding the deal, negotiating, buttering up the seller. Two, asset management. Buying the property, running it, making sure the business plan is being done. And three, raising money. Sunrise is very good at acquisitions and asset management. We're very good at capital raising and asset management. As you can see, we double up on asset management. We think that's very important because it's all about execution. And so we're on weekly phone calls with the property manager directly. We walk the property once a month. So what I tell people, we're like primary care doctors. We trust these anesthesiologists and cardiologists, but we're looking at the notes to making sure all this stuff is done. And because the if you're busy working on the day to day, you're talking to the maintenance, you're leasing up, it's hard for you to really think about profits, right? So because we're one step removed from them, we're really able to be like, okay, maybe we should do this marketing campaign, maybe we should do this, and because we work with so many different sponsors, we're able to kind of pick and choose what works and carry it on to our properties. So that's kind of the general roles. Anything you'd like to add, Peter?
No, I mean, I think that part of what we've done as a strategy is that I think Pranay, you mentioned this, is that we don't try to do everything all at once. I think that we figured out kind of what we do best, and we try to find partners to kind of make up for the rest, and people that we can true partnership with, we can get more heads in there. And that, obviously some people, we see each other's blind spots, which is really great. And so that's what I think makes our situations kind of pretty unique. I think some of the people that you might invest with, some of them just end up doing one of those three things. And sometimes they'll just do the capital raise, but they won't really be involved in the asset management. They won't be involved on those calls. We actually think that part is just as important, if not the most important, to protect people from an investor basis. When we set up our arrangements in terms of structure, we're not like limited partners. We are straight on partners where we can make decisions to buy, sell, refi, rehab, whatever those decisions. I mean, that's in our hands, and we want that because we feel like that control is necessary to, again, protect people. And it's not when times are good. I mean, when times are good, you can basically do anything and do fine. But it's when times are challenging, or the market gets rough or whatever, then you really need to have that strong arm to be able to do things so that it's right by investors and look after them. And so, again, this has been trial and error for a little bit for us to figure out what system and what structure we like best, or that works best and protects people. So we think this is the best structure in place to create everything that we want in terms of returns, mitigate risk, protect investors, and really create the type of deals that we want. So does that make sense, Pranay?
Yeah. And the other thing about that Washington Journal article, uh, people were screaming for help in terms of the government and the pool was green. Like, we have a code of ethics. Like, we want our tenants to be well taken care of, to be able to call their apartment their home. So if we saw that, we would, that wouldn't be okay with us. And that's, that with us on board, like, we're really trying to make sure we take care of people just like we take care of our patients. We want to make the world a better place in the way we invest as well. There was a question about preferred equity. So we wanted the best loan that we can get, and we got this green loan from the government. But the government after 2008 has gotten very skittish in terms of giving out their loans, and uh, th- the property is about 87% occupied, which is great for a developer builder that doesn't do property management to get it up there. And our contract actually stipulates that they have to get to 90% before we'll take over. But the, in the government's eyes, that's not stabilized. Stabilized is 95%. I can promise you we wouldn't get that $21 million discount if it was stabilized, right? So it's kind of a give and take. But because of that, the government is giving us 51% of the total cost to in terms of the loan. Now, in terms of risk, that's great, right? If you put half the down payment and half you other half, so you put half cash and the other half you get a loan, the risk of that defaulting is very low, but also the returns are very low. So we're adding preferred equity a little bit on top of that to get us to around 68% or so loan to cost. So we think that's a nice balance. We're still putting in about 32% down payment, which is a lot more than you and I would, but still high enough leverage that we're still giving a nice 13 to 15% return. So that's what the preferred equity role is. They don't really call the show. They are just there to kind of provide us some extra proceeds for the loan, since the loan started off at about 51%. So someone is asking about depreciation. So the way depreciation is going to work on this property, we're expecting about 50 to 70% of the depreciation in the first year. And that's because of cost segregation and bonus depreciation. So if you put about $100,000 in the first year, you're going to get about 50 to 70,000 in negative losses. Now, people reach out, they're like, Pranay, we lost $50,000 in the first year. No, it's just the way the government structure works. They say, hey, you have a negative loss. Now, if you have a W-2, that depreciation isn't useful to decrease your taxes. What it is useful for is all the returns we're going to give you are tax deferred until we sell the property. So it's nice, right? The government's kind of giving you a loan, tax-free loan for 5 years. So now if you have other rental properties that are making positive money, or maybe you're a partner in your practice or pizza parlor, then you can actually use that depreciation for yourself. The nice thing is it stacks up. Even if you don't use it this year, you have it forever until you can use it. So it's always nice. And bonus depreciation is going down every year. Last year was 100%. This time it's 80%. So it's nice to get in as much of it as you can, because I have no doubt you're going to be able to want to use it in the future. So that is remember, that is only useful against passive losses or passive gains. So you can't use it against the stock market, unfortunately. You can't use it against your active income, but any type of passive gains. So someone was asking about their specific scenario. Just message me and then we can go over it. So Peter, someone's talking about 3 to 5% cash on cash, and they're talking about savings accounts that are probably pretty similar. Talk to me about what your kind of portfolio looks like, and why you have a bunch of real estate instead of just millions of dollars in T-bills.
No, I think when you think about your portfolio, I actually had somebody, I don't know if they're on this webinar or not, but I had somebody come to me and just give me a scenario. I'm pretty much all in cash right now. I don't have much investments, but I have several $100,000 in cash right now. It's sitting in a savings account. Should I invest all of it? Should I leave it in my savings account where I'm getting close to 5%? What should I do? And it's hard to answer a question like that without knowing people's individual situation, right? Knowing what their goals and objectives are. And so when people ask about sometimes like the best allocation of funds, I always, unfortunately, I tell people it's a personal decision. But what I do is I tell people to start from the beginning. And it may sound cliche and all this stuff, but I'm just like, what do you want? I'm like, what kind of life are you looking for? What kind of outcome? What kind of goal? If you're in a situation where you're like, hey, I'm happy to continue working when I'm working, I make good money, things change, that's fine, but I'm going to keep working. And I just want money to be there for me when I retire in 25 years. At that point, I'm really to just kind of relax and take whatever. But from now until then, I'm willing to kind of just grind and go for it. I'm like, okay, well, then probably makes sense to throw all your money into like your retirement accounts, right? Where it's going to be tax deferred and you can be able to access it when you're 60 years old or 65 years old. But there are other people who are like, no, I want that cash flow today, right? And I also want to be set up also for retirement when that time comes. And so that becomes a little bit more complicated. You got to think about how much cash flow you need today, how quickly you want it, and then how are you going to build for future net worth as well. And so thinking about that, you got to think about how much cash you have on hand and then how you want to invest. I will tell you that interest rates and savings rates for savings accounts will go up and then it'll go down. I remember the last time it was 5%. I had money in there. It would be 5%, then it'll be 3%. And then if you remember, it was down to like less than 1%, right? At that time, people could have ridden that the whole way. They would have 5%, 3%, and then at a certain point, they wouldn't have any money. None of that would be growing. I absolutely believe it's important to create a diversified portfolio to accomplish your goals. Some you're going to have for, hey, this is a cash flow play. This is purely cash flow, meaning that I'm going to get maybe a higher type cash flow return. Then you have your cash, and we're going to get 3 to 5% in your savings account. There's risk and return there, right? And you want to kind of mix and match all that. Then there's other returns where I want in my portfolio where there is some cash flow that's ongoing, that's tax protected, but also there is an ability for that to grow as well. When there's an exit, when the value of that continues to grow. People who are investing in real estate, well, especially this type of real estate, they want a little bit of both. I think most people, they want a little bit of cash flow that comes your way that can replace some of your income or you can put towards future investments. They want that as tax protected as possible because right now you probably have income that isn't very tax advantaged at all. So they want some of that, but then they also want this nest egg, whatever their basis is or whatever their money is that they invested to grow as well. And they want to continue to grow that. So every time they take that to a new deal, that basis is bigger and that percentage you get. And maybe, like I said, maybe that percentage is 6 to 8% cash flow, whatever it is. It's a bigger pool each time and it grows with you. And so that's what's been the really focus of my portfolio. The majority of what I invested is stuff that does cash flow. It may not cash flow a huge amount right off the bat, but it grows over time and that cash flow and continues to increase. And you stack enough of those things, you start to get really significant cash flow after a little while. So again, this is not a get rich quick scheme. It's a get rich soon, I'd say. And it's also cash flow sooner rather than like when you're 60 years old. So all that to say, yes, you can put it in 3 to 5%. So you can put it in a savings account, which is fine. In fact, for part of your portfolio, you should probably do that. You should have a small part of the security bucket for your portfolio where you should have right now money in either T-bills or in savings accounts or CDs or whatever you want, a portion of that so that you kind of always have that security there. However, if you're trying to accomplish your goals, where you're trying to gain assets, you're trying to grow your net worth, increase your cash flow, the only way to truly meaningfully do that is to invest in things that will get you more than 3 to 5%. And I believe that real estate is one of the best ways to do that. If you can do tax protected, even better, because it kind of compounds over time. And so that's my thing on it, right? I mean, there is, again, with different investments, there's going to be a different level of risk, but you should expect a different level of return. I'm not saying invest in something that is extremely risky and that you only get 3 to 5% on it. I wouldn't say that. Look at everything from a risk adjusted return and create your buckets in your portfolio to do that. And I would absolutely do that. If you don't have a friend you can do that with, some people have a financial advisor, that's fine. But if you have somebody or a community of people that you can do this with, is look at your portfolio holistically. I don't tell people put all your money into this deal or this kind of thing, because again, you want to create that diversified portfolio, and it depends on what else you have in your buckets already. So that's my take on it.
And that was like a master class in asset
Oh,
allocation. Thanks, Peter. Someone is asking about unit types. So if you look at the deck, the unit types for Cabana, there's about 114 studios, 114 single bedrooms, and about 58 two bedrooms. So the cool thing about the property is the studios. The studios are actually the highest in demand. And they're a foothold for people to get into this Goodyear market. Goodyear average median income, 123,000. So a lot of people want to try to move in, but they're young professionals. They don't necessarily need a one bedroom, or they don't have a family. There's only one other place that has studios. And so we actually think that's our competitive advantage to get people in. And then once they're in, they're going to see all the amenities and want to upgrade. So our studios are actually kind of our fastest growing properties unit class. So we love those, and it's our kind of competitive advantage. Someone asked about the closing date. So closing is June 30th. However, the property there's a difference between closing and fully funded. Usually our deals are fully funded 2 to 3 weeks. We just opened a deal and we're already about 30% full. So I think it'll go pretty quickly. So if you're interested, I tell people to try to get their decision in by next week and get their wire in, because especially once we get past 50% full, people are like, oh shoot, I got to get up and get my wire in. So every single one of our deals, we've had people that we've either had to refund or they don't make it at the very end. So if you're interested, either get on the phone with me or Peter and let us help you answer any of your questions. So someone asked about the track record of Sunrise. It's in our deck. They have 5 full cycle deals in Phoenix. What we love about them, they live in Phoenix. So they live about 20 minutes from this property. Ignore the IRR because it's like 60 or 70%. We're not in those times. We're not going to hit that anymore. But we want to try to hit 13 to 15%. I can tell you our last deal, Enclave on Bethany, was with Sunrise. It closed in November of 2022. First check went out in January of 2023. It's only been about 5 months. We've already hit what we expect to hit in year 3. So they're super competent, really know what they're doing. And our deal, Bethany, is killing it. That's why we jumped at the opportunity to be able to work with them again. So Peter, people, 5 years is a pretty long time from now. And we don't know what's going to happen. People think rates are going to drop, but what do you think? What do you think we do if we're getting close to the end and there's a recession and we're considering selling the property or refinancing? Just kind of what is your thought process around that?
Yeah, I mean, I think that if where do we think we'll be in 5 years? It's just it's a prediction, and we go by probabilities. And I would say that again, if you're looking at probabilities, the chance that we're still in a recession in 5 years is probably very, very small, right? Because if you look at most recessions and how long they last, and we're talking all the way back to, I'd say that even the Great Depression, they don't last longer than a year. In fact, they're less than a year usually before they start to rebound. Now, however, that being said, we're going to prepare in case we're not in a great situation in 5 years. So what we've done is we've given ourselves, we had the option probably, Pranay, right, to go with a shorter term loan, which we decided not to do. We decided to extend this out to 5 years, number one, because we felt that would put us far outside any window that's possible. It just minimized that chance of probability. However, in case, we also looked at what are the scenarios exactly if we hit that 5 year, what position, what would cause some issues for us right then. Number one is during the time, right, either you want to hold onto the property, right, or you refi, or you're able to sell. Now, obviously, we want to do what's best by investors at that time, whatever makes sense, and we'll take a look at that. Number one, we're not going to wait and make that decision at the last hour. That's number one. I think we'll know a lot by a year, 2 years before that. We'll know where we're at and where we're going towards that. But we always want to make sure that we're in a situation we can at least have multiple exit points. And this absolutely gives us an opportunity to do so. Pranay, talk a little bit about where you think the debt service coverage ratio is and why that's important when you actually go to refi a property.
Yeah.
I think that's a good teaching point.
Yeah, so the debt service coverage ratio, it's basically the ratio of how much money you're making compared to how much money you're spending, right? And you want that. So lenders require 1.25. Ours starts off at 1.8, which is crazy high. Most people don't even end at that high. And we actually we have something called an interest rate reserve. So the lender has given us a little bit extra money to pay themselves back. I know it sounds kind of a little funny, but they believe in this property so much. So that means we don't have this burden on our shoulders of worrying having to pay the debt. So that's why it's 1.83 in the first year, 1.96. And then it becomes that last 2 years, and then it's still 1.6. So even though we got rid of the interest rate reserve, and it slowly builds up over there. So what that means is we're making so much extra money compared to how much expenses we have. So that's the NOI. So what we could potentially do is refinance, because a lot of people call it lazy equity. That means the value of the property is just worth so much more. And the value is directly tied with net operating income, how much money the property is making. So at the end, we could do a refi, cash out refi, meaning we send a big chunk of the money back to our investors, also called the infinite return model. So if you get close to getting all your money back, but you still have a stake, like say you have a 1% stake in the property, you're still getting that profit. Ideally, we'll try to sell the property, but Peter, Myth, and I were very patient. That means we'll do whatever makes sense for our investors. And if we have to hold the property for longer and get a refinance, we can do it. But because we're getting this debt fixed long term, we can really ride out whatever happens. And because the net operating income, the money is higher, even if say interest rates are 7%, we can still cover that because the property is going to make so much extra money. So we're really thinking like, hey, what is the worst case scenario and how do we prevent that from happening? And now if things get better, which everyone is predicting to happen, this is going to be a home run. But if everything is going down the blender, right, down the toilet, this is going to be a double. And that's how I look at it as a success. Like I still want a positive return, even if everything's, stock market's down 25%, bonds are down 25%, right? That it's protected from that. And that's why, we like real estate. A lot of people are asking how much we have in the deal. We actually have $1 million hard money in this deal. So potentially we could lose it if the property doesn't close. But that's how strongly we believe in this money. We put our hard-earned cash and the random fees and stuff that we have to pay, but we really believe in this property. And so we split it with Sunrise, $1 million minimum.
Well, that's to start with, right?
To
And
start off with, yeah, to start off
that's
with.
just to
And
start off with. We put that money down out of our own
Mhm.
pockets just to do that. And then also, of course, we co-invest in every deal.
Yeah.
We try to honestly, like people, Pranay knows, I try to put as much as I can into every deal. But sometimes for some of those things, you have to make room for some investors on the back.
Yeah. I've actually had in the past to refund myself because someone's begging at the end. They're like, please let me in. And I'm like, okay.
We've had to refund some of there. Yeah, but
Yeah.
so I think we try to do, I mean, Pranay, the numbers in terms of minimums that we try to co-invest, right?
Yeah. So
At
we'll
least
be at least 100,000 each, including money from us, not including money from Ascent. Ascent has $1 million, but ourselves at least
personal.
100,000
Yeah. So
personal.
we'll put our own personal cash in here as much as we can.
Yeah.
Because again, this is where we feel like the investment should be. And honestly, we're not really seeing much else out in the marketplace
Yeah.
that kind of matches this kind of a risk return profile. So we're going to be putting a good amount of our own cash. We put Ascent cash in there. And of course, we're riding along with investors. So we want you to know that. So let's see. What else are we seeing in there today?
Yeah, someone is asking about the cap rate. So the cap rate is kind of interesting. The cap rate is it's your net operating income divided by your purchase price. So the net operating income right now actually isn't as high as it could be. Like I said, the occupancy is 87%. So we know we can make that better. So the cap rate is actually lower than what you expect because the net operating income, the numerator, is lower than it would be. So
Can you
there,
explain what that is real quick with the
yeah. So The cap rate kind of tells you about the market sentiment of the building. Like how much how
So
much are you willing to
explicitly
pay?
though, why our net operating income is a little bit lower
Yeah, yeah.
than
So it's like how much you want to pay per dollar, and the net operating income in this property is lower than you expect. One, because occupancy. The builders, they have other focuses. They're literally building things, and they haven't focused on property management. Two, they're doing silly things like they're paying for all the electricity for all their tenants. I've always had to pay my own electricity, water, trash, and we're going to do that. We're going to build that back to them, which is normal. So that's artificially decreasing the revenue, which is good for us because we're able to ask for a discount. So if you look at after we buy the property, what the cap rate would be, it's actually going to be 5.3. So it's right around the same as what our interest rate is. So it's rare to be able to buy and a new construction at a 5.3. Everything else, even value add in Phoenix, is going for a 4.5. So we're getting this for a much better cap rate than pretty much anyone is. And that's because the builder is really motivated to sell. So that's why. Uh, Someone talked about preferred portion, the preferred equity. So the way it works is every month we have to pay them 4%, just like debt. We have to pay them, and then it's optional up to 6%. In total, we have to give them 12 and a half. And you're thinking, oh, 12 and a half is a lot. But remember, we're giving you we're predicting to give you 13 to 15%. So actually having them in the deal increases your returns a little bit because they're capped at 12 and a half. So their portion of the money is capped at 12 and a half. And we're predicting even higher than that. So that's preferred equity. And it's only a 4% that we have to pay them every year. And potentially we could refinance them out. They don't have a different waterfall. 12 and a half is their cap. It's there's that's it. Yeah. Who is running property management? This group called AMC, they own 20,000 units. And more importantly, they own 3 Cabana properties. So they really know how to run these properties well. And those properties are killing it, despite people paying way more than we did for our property. So they were the ones that recommended that we turn the laundry rooms into rentable units because we're adding washers and dryers to all the units. So that change alone will add $1 million to the value of the property just by adding those 2 units that are rentable, right? Because 1,500 a month times 12 months times 2 and divided by the cap rate. So is there a possibility of a capital call? I can tell you we've never done a capital call, and I can't promise we never will, but go kicking and screaming if we ever have to do. But that's why we're investing in cash flow deals. So as I mentioned earlier, if the property's covering all its expenses, has a very big cash reserve, not only does it have a cash reserve, we're actually raising all the money for the capital renovation, so the washer dryers, electric charging and stuff. So that's another pot of money that we can access in case the economy gets worse. And on top of that, there's a 3 to 5% we're planning on giving out in the first year that goes up after there. The chances of a capital call are not zero, but as close as we can make it to zero. And like I said, we've never done a capital call before. What is percent of the GP? The way the waterfall works, so some people ask about a double waterfall or anything like that. No, is you get 100% of the profits up until 8% a year, all your money back, and then you get 75% of the profits. And what it works for us, we'll split the 25% with Sunrise. And so that way you're not getting charged anything extra. If you put in more than 250, you're going to get 9% preferred return. And we're going to send out an email on this soon. You're actually going to get a bump up. We're actually giving you some of our GP shares. So instead of 75-25, you'll get 80-20. So still so 9 pref, return of capital, 80-20. Now, if you put in more than 500, you'll get 10 pref, return of capital, and 85-15. So a lot, and that comes out of our pot, not the LP pot. It comes out of the GP pot. Do you have to wait for lease renewals to do chargebacks on electricity? Uh, yeah, but leases are changing all the time. One of the nice things of buying an apartment is that uh, there's always people moving in, moving out, and so that's something that you don't want to change a contract while it's still going. But yeah, we'll be adding that slowly into the properties, and they've had a lot of success in 3 other cabanas that are all within about 20 miles of this area. So it's been super successful. Oh, hey, Myth. Uh, so are you adding covered parking? Uh, we're gonna look at covered parking. There's already electrical charging. We're looking into covered parking, and we're looking also into reserved parking. So as you can imagine, it gets 120 degrees in Phoenix, so people appreciate covered parking, but we also got to check with the city. So that's part of our kind of value add that we're looking into, but not confirmed yet. So
And even within the submarket,
yeah.
there's actually a lot of the comps that I saw, they have reserved parking and it's really in demand. So we could add those reserving spots close to your building in specific. That's always a big sell, particularly in a Class A location and Class A properties.
The scope of this property, I mean, as you can see, the value add, we're really trying to be kind of very specific, surgical in what we do, right? The property is brand new, doesn't need counters, doesn't need cabinets, doesn't need floors, but we're being very specific in what we do. So washers, dryers, we know everyone will pay for that. Turning the laundry rooms into rentable units, that's obvious. There's 2 model units, we're going to change one of them into a rentable unit. And then reserve parking, that doesn't cost us anything, right? So and then pet rents, bundling, doing chargebacks, also called rubs. And then other stuff we're going to look at, we're going to change some of the outdoor, um, maybe add a volleyball or pickleball court. But we're really looking at like the low hanging fruit. And we think there's going to be a ton of value and the property itself is very in demand. So, less is more. The property that I was talking to you about earlier that I have with Sunrise, we haven't had to do a ton to get that year 3 rent already. So less is more, right? Especially for a property that's like ours, you don't want to necessarily spend all this cash unless you know you're going to get an ROI from it. So we're going to be very tactical in how we kind of go about doing that.
Renee, can you turn on Myth's camera? Allow
Yes.
him.
Yes. A co-host. Yeah. That's the last question I have on there. Overall, so feel free to add it. I'll look at that. Overall, we love this deal. It's brand new construction. Takes a lot of the maintenance, repair risk, execution risk off the table because we don't have to do this heavy value add. One of the largest risks, debt, is not really a big concern because we're getting long-term fixed debt and it's cash flowing immediately. We're going to send out our first check in a couple months after we take over this property, just like we did Bethany. And that makes us feel good because we know that the property can really handle anything that's happening in the world, right? So 2 real focuses: capital preservation and cash flow. And we know, and that's with potential recession coming up. But if there isn't, if interest rates go down, cap rates go down, this is going to be a home run. You can kind of see that in the sensitivity analysis. Someone's asking when we're going to lock in the interest rate. We're looking to lock it in pretty soon because this is through agency, because it's through the government. There's not this wild swing that you see with adjustable rate or bridge loan, but we're probably going to do it pretty soon. They said, we've been talking to them every day. They say maybe 5-10 basis points, so 0.05 or 0.1, it'll kind of change one way or another. But we're keeping a close eye on the market. So if we see something going to happen, we'll go in and lock it. Great questions, Larry. Okay, so
Yeah.
long term. Okay, so let's see. Yeah. Okay. So I get this actually question decent amount of times, talking about kind of the environment, water. Those are really concerns for long term. If you've been paying closely to what's happening, actually the federal government had to step in, and they just made this like epic agreement between California, Arizona, and Vegas. So there's a lot less concern in terms of water rights and environmental. The nice thing about this property, and one of the reasons we like it, is that it's very attainable for most people. So to live there, your average median income could be 60% of the average median income. So a lot of people are able to get into this property, and we're able to take care of them. But because we got it at such a low basis, such a low purchase price, we can actually push rents and still make a profit while giving people a great place to live. So it's kind of two birds thing. So we really jumped at that opportunity. Yeah. Cool. Any remarks, Smith?
Someone had asked, what's our experience with buying newer properties?
Mhm.
Through our fund and with Olympus, we have had much newer vintage properties. Also with MG Properties, actually, it was the first two deals that we did. Those were all much newer properties, particularly the one in Bellevue. And so the returns for newer properties are actually, I mean, they're less, but the risk is actually less, because when you have a really big value add, you're banking on spending $16,000 a unit and then being able to increase rents $200, sometimes $250. But for this one, the rents, as you can see in the pro forma, we only have to go up by $50 because it's not only small little tweaks. And that's what we really need in the time of a recession. You don't want to be having to be the top of the market. You just want to be able to just adjust a little bit, capture a little bit more value. And so, yeah, we have experience through some of our, actually our first deal and then our multifamily fund.
Yeah, if you look at the average rent of the Cabana, it's like 1460 and way lower than the average rents for the Goodyear area. So we just have a ton of room to move up and go down and up and down. So we can really handle kind of anything the economy throws at it, throws at us. And this is, this flexibility I think is super important in kind of this type of market. Yeah. Peter, any closing remarks?
No, I mean, people have asked again how much how much longer this deal. We've talked about it. It's going to be until the end of June, right? Again, the interest has been really high on this, so we're really excited by this. I think in this market more than ever, there aren't a lot of good opportunities out there. In fact, I tell people that we weren't even planning to do a deal. We had one deal that fell through early on in the year, and we're like, we're not going to do another deal to the end of the year. But this thing was so compelling that we felt the need to do it. And so really we had to make sure the story was right, the opportunity was right, risk was right, and all of that. And that's why we're really excited to bring this opportunity in front of people. We're happy to talk about it to whoever wants to talk about it. We'll talk about it all day. We want to just help people move forward with this in terms of finding a good opportunity. This, for a lot of people, I know this may be your first deal. And so people want to talk about it a little more, and we're okay with that. And so please reach out to us. Let us know. We're excited about this opportunity, and whatever we can do to support you in this, let us know.
Yeah, and I just put my cell phone number in the tech. Let me make sure I typed it right. Yeah, 858-699-5199. So if you have any questions, just text me. Happy to answer. I've been talking to people all day because we're in a weird time in the economy. And this is really the best deal we've seen in 6 months. And there was a reason that we jumped off the sidelines for this and are putting a large amount of our capital. So yeah, like Peter mentioned, the deal is going to close into June, but we're going to be fully funded well before that. So please do get your hard commit and your wire in probably in the next week or two. And if you have any questions, like please, like this is even the minimum 35,000 it's a lot of money, right? And we've fortunately been having people put in a lot more than that, but any amount is a lot of money. So please call us, text us, so we can kind of tell you why we like this deal and what's so great about it. So thank you, everyone. We'll be doing this weekly for the next couple of weeks, especially with all this economic uncertainty and kind of scary times. We really want people to be well prepared for handling really anything the world throws at it. So if you have any questions, like feel free to reach out to us. Jenny asked the two last questions. This will be available. We'll send this out shortly. And yes, we can take retirement accounts, EQRP, solo 401k, and self-directed IRA. We're happy to take that. Yeah. Thanks, everyone. Bye.
See ya.
Thanks, everyone. Bye.